first time. I mean, this is where now you're going to see again and again the limitations of accounting methods. The limitation is when you try to make decisions based on accounting numbers. Now, knowledge of these methods and how these methods can influence the accounting numbers becomes extremely critical because you're going to base decisions on. So that is why what happens is a lot of analysis. That's why what happens is a lot of analysts, in order to make numbers comparable across companies in the same industry, they will change the numbers to make them comparable. So if, let us say, if they are comparing two companies and one is using method A, the other is using method B, they will redo the financials using the same method for both and then make their recommendation. So that way you're comparing apples to apples, you're putting them both on the same methodology. But both companies are perfectly at liberty to use either of the one of the three methods. Right? Any questions on this? Because this is what is necessary for you to know from an exam point of view. And I might come back and do other things later on, but this is what is necessary in this chapter, chapter 6, to know from an exam point of view. So I'm going to cover chapter 9, and then I'll come back and we'll continue with some more problems in this example. And what we cannot complete here, I will send you the answers so that you can do it at home and compare the answers. So I want to finish the depreciation thing, and then we'll get back to this. Okay? So far so good? Anything here that is sticking out that you really want me to explain? Yeah, sure.
That one, when you did the FIFO, the one thing.
Yeah. Why?
Why did you not use? I mean, it's, I think I'm missing the first.
You have
one.
only 100 units left.
I mean, I got that piece. It's just that why did you use 120 if that was 3-1?
Because he was the most recent purchase.
The most recent purchase was on 1st of June.
The most recent purchase was March 1st.
No, 6/1, June 1st.
No, the recent
Oh.
from March to
You
June.
bought 200 units on
I see, because you're looking at 630.
Yeah.
Okay, and all right, that's what I missed.
But my professor, for the second one, why are we using?
Ending inventory using LIFO, correct.
Yeah, why are we using one instead of the one?
Instead of what?
Instead of the one.
This one threw me off.
Because remember, the one was already available to you this year to sell. It is the beginning inventory, it's there, it's sitting there. So you are going to assume that when, the 200 got sold first and the 300 got sold first, so you're still left with that 100. Because you're using LIFO, so for the sale you go backwards. So you assume that, for every time you sell, you sold the 200 first, then you sold the 300, and so the 100 that you still have left is right there on top. The beginning inventory is still left. Right? So your ending inventory in this case. Now, so the question is, I think 2 or 3 of you asked me this question before we had the break. So what if your ending inventory was, let us say, 102 units? If you had 102 in ending inventory, then under LIFO, what would you say? You would say that it would be 2 from,
100 from 6.
okay, it would be 2 from here and 100 from here. The ending inventory was physically 102 units. Then you will assume that yes, 2 came from here and 100 came from here.
On the FIFO relief,
Under FIFO, the entire 102 will be at 150 because this is more than 102. So
like
it
if we
will
have,
be
if we have
100.
202.
So the whole 202 is sitting here.
Then what would be the cost for the two? Would it be for the 120?
No. What is the what? The cost of goods sold?
No, if we say if the end inventory was 102 units,
Uh-huh.
so you'll be 2 from the 300
at 120.
Yeah, no. 2 will be at 120 and 100 will be at 1.
and then 100. Okay, got it.
At LIFO, right?
Yeah, that's like right. That's right.
Yeah, that was my confusion. I'm like, why are we using the 120 when we use the 150 before? But that's because the ending inventory is in the room.
Yeah, that's right. That's right. Okay?
Professor,
Yes, sir.
if those 100 units sold were before June 1st, then you would use the cost of $1.20, right?
No, this is not 100 units sold, it is inventory. The 100 units still left.
Okay.
This is what you're physically seeing on 30th of June. So you're first putting a value to this, and then deriving that for what cost of goods sold should be.
Right.
All right, guys, let's move on. Yeah, so we are going to go over. We're going to go over chapter 9, but before I take up the computation of depreciation, let me get some things off the, some introductory materials. Okay, so let's begin with. Alright. Chapter 9 has to do with long-term assets or fixed assets. In many countries, they call them fixed assets. Fixed assets doesn't mean that they are fixed in one location. It just means that they are there with the business, helping the business earn revenue over a long period of time. So examples of these assets would be land, buildings, equipment. Okay, these are all examples of assets that have got generally a long period of life. So the assumption is that you're using them to earn your revenues and therefore profits.
These are plants, right?
Sorry?
These are plants.
Fixed assets.
Say that again? Plant assets. Yes, they're also called plant assets. Absolutely correct. There are multiple ways they are classified. They are called property, land, perfect, and equipment. Very good. PPE, property, plant, and equipment. And in some countries, they call them fixed assets. But usually the term fixed assets are not used in the United States. In the United States, the terminology is always property, plant, and equipment. Now, so what are the things that really matter here in an accounting sense? Okay. The things that really matter in an accounting sense would be as follows. Number one, how do you account for the acquisition of the asset? Second, accounting during use of the asset. And three, at disposal. Either it is just thrown away or it is sold. Basically, the asset is no longer with you. Typically, with all these long-term assets, why? Because they have use for a long time. If it is inventory, the use happens very close to the acquisition. But with things like land, buildings, and equipment, they are used for a long time before they are disposed of. So therefore, typically accounting would be involved in 3 stages, which would be acquisition, during the use, and at disposal. So I will take you through an Excel sheet computing these 3 cases. For 2 and 3, I will take you through an Excel sheet. But let me talk about the acquisition part first. The accounting rule for acquisition would be the asset is recorded at a cost which is equal to what was get it to intended use. To get it to its intended use.
So like, let's say like a renovation or.
Anything that is necessary, this is important. There's a difference between what you spend on it and what you necessarily have to spend on it.
The first thing says total?
So the first thing is, the asset is recorded at a cost which is equal to what was paid for it, plus what was necessary, that is the cost that you incurred, addition to what was paid to get it to its intended use. And typically, this is usually the problem most of the time. What was paid for it is very easily verified. You have an invoice and you pay. Or you have a note which says I will pay. So one way or the other, what was paid is clear. And when I say what was paid, please don't take it in a cash sense. It means that it's either paid or it will be paid. Okay, so it's like an invoice for that asset. But what was necessary to get it to its intended use? So let me give you some examples. Let's say you buy a piece of land and you want to build a factory in it, or you want to build your office building in it. But the land has got already an old dilapidated building sitting there. So you cannot build anything on that land unless you destroy that building.
Correct.
So you got the land along with that building. So now if you spend money destroying that building, obviously you have to spend money to destroy it, and maybe you will get some scrap value out of the material that you got, that will go here. So the additional money that you spend to destroy the structure that was already there, minus whatever scrap value you receive, that will be the side. This is easy. Whatever you pay to buy the land. Okay? Now, what is not included here is, let us say you bought a piece of land. There was nothing there, so you can start building your building. What you did was you went and put a fence around it. Now, that is not necessary for its intended use. The fence is separate. You don't need to put a fence in order to build something in the land. Okay? So that will not go. So when somebody reports what is the cost of land in the balance sheet, that cost will not include the cost of the fence. The fence cost will be something else. It will be called land improvements. Or you put some fancy, landscaping in there. You want to put some fancy landscaping, that's entirely your discretion. But you don't call it as part of the land account. You call it as part of land improvement. The reason why you have to separate them out is because land is not depreciated. There is no depreciation on land. Why? Because the assumption is that it has infinite life. Land never has an expired life. So because it doesn't have an expired life, you cannot depreciate. There is no depreciation ever charged on land. But buildings and land improvements, things like fences and the landscaping, all those things have to be depreciated.
So what if you purchase my land and the market goes down?
Yeah.
You lost that.
That's a different matter. But under U.S. accounting right now,
Yeah,
the fact that the market has lost value will not change your account. The account will remain at whatever you paid for that land. Yeah, it's all the cost. Correct. Yes, sir.
No, it was the same
Same
question.
question?
So the building on the land can be depreciated, but it will be totally separate from the land.
That's right. If you build a building, and let's say you set up your office in the building, very good. So now the building is a separate account altogether. It will be depreciated. Correct. That is correct. Any other questions?
That's very strange, because you're telling us that land, buildings, and equipment are property, so they don't really depreciate as much.
Sorry,
So,
I can't hear it. Somebody is talking in this area.
huh?
I can't hear it. Go ahead.
You're saying that land, buildings, and equipment are fixed assets, and that land does not depreciate, but the other two categories do.
Yes, they do.
So they did that.
You heard my answer, right? Because the reason why the other two depreciate is because they have finite lives. For buildings, the assumption is that it has a finite life, 20 years, 30 years, whatever that is. But for land, it does not have a finite life. So you cannot depreciate it if it doesn't have a finite life. The denominator is infinity, so there will be no depreciation. That's the reason. It is a question of life. If the life is finite, it is determined to be finite, then yes, it has to be depreciated. Correct. Any other questions? Okay, so that's the point. So in any given situation, you have to assess whether the cost was necessary in order for the asset to bring the asset to its intended use or not. So for example, in the case of equipment, this is very typical. I mean, I have seen examples of this in India, for example, long ago. When they used to get highly sophisticated equipment for the hospitals in India. At that time, they were not making it indigenously; they were importing. So a lot of the staff in the hospital needed to be trained on the use of the sophisticated equipment. So what would happen is that the equipment supplier would also send a technician along with the equipment. The technician would stay in the premises and actually train the local staff excuse me, on how to operate the equipment. So for 1 month or so, that technician's complete expenses have to be paid. Now, when you look at the word equipment in the balance sheet, that equipment will now include the cost of whatever you have to pay for the technician to stick around to train everybody. Why? Because the intended use criteria will apply. You cannot use that asset unless you are trained to use it. So therefore, whatever expenses are incurred in order to bring that asset to its intended use. Sometimes other examples would be that, okay, the equipment comes, it cannot be installed just there. You need to build a separate, some kind of a platform to put up that equipment. So the cost of the platform now becomes part of the cost of the equipment. Why? Because without the platform, the equipment cannot be installed, so no intended use. So based on a case-by-case situation, you have to assess whether the cost was necessary to bring the asset to its intended use. Okay? So that's the first thing, that is on the acquisition cost. So land is not subject to depreciation, but the important rule for acquisition is that whatever cost was paid to acquire the asset, as well as whatever cost was incurred in order to bring that asset to its intended use, will have to be included in the cost of the asset. Right? So far so good? Any questions? Now we go to the second stage, that during the use of the asset. During the use of the asset, the only thing that matters is, of course, depreciation. So I'm going to take you through a depreciation example, and that will also take into account both during use and at disposal. Both will be considered. So let's look at the depreciation combination through this Excel file, which I've also included in the course site. You should see something called intangibles, interest capitalization example. Like depreciation, intangibles, and interest capitalization. But it will be probably the next week. It may not be in week 2, it may be in week 3. That's because this program is unique in the sense that it does not meet on the 3rd week. So it should have been moved to week 2 because that's when we are meeting. But they might have put it in week 3. I don't know.
I've been here week 2 and 3.
No, under Swedish English or something like that. Let's see. Give me a second. Okay, so it's not here. All right, give me a second. Let's keep going. I know, I put out this slide from right here. So let me go back to post content.
No, man. I'm running a door.
It's not here. Here it is. There you go. They put it in the wrong week, folks. I'm so sorry about this. I'm so sorry. They put it in weeks 4 and 5. There's no way week 4 and 5. I'm sorry. This should have been in week 2 and 3. No. See, every time. Now, this is really the truth. The truth is that after they set up the if you remember the boot camp example on the equipment, we said $50,000, 5 years useful life, zero salvage value at the end of 5 years. So how much was the depreciation each year? So we came up with $10,000 in depreciation each year. Anybody remember?
That was a simple one.
I'm sorry?
That was a simple,
Same thing here. You see the exact same thing here. So, so now how do we compute the depreciation? So now basically what I have done is that I have given you two kind of extreme examples on the depreciation. The first is what we call as a straight line method. The straight line is the most commonly used method. In fact, it is more predominantly used the world over as compared to any other method. So the straight line method is very simple. The amount of depreciation charged each year is exactly equal. So you simply take the depreciable cost, which is the assets cost minus the salvage value, divided by the useful life, that's your annual depreciation. Every year you charge that much depreciation. But remember, every time you charge depreciation, that becomes a reduction in owner's equity because it's an expense. And at the same time, you put it in an account called accumulated depreciation, where it accumulates for each year until the whole life is expired. Okay? So therefore, let's take this example, and I have put some formulas in there. So when you review this file, you should also know, you should be able to see how I got those numbers, because most of the numbers are based on the formulas that I have put into the set. So you should know how we got it. So now what we do is we take the machine was bought, on 1103 for $6,000, and we are assuming that there is no salvage value at the end of its useful life, and we assume that it has a useful life of 4 years. So therefore, under straight line, the amount of depreciation we charge each year would be 6,000 minus 0 divided by 4. 6,000 divided by 4, which is $1,500. So every year you will depreciate this asset $1,500. And remember, conceptually, why are we charging depreciation? Because we want to make sure that the cost of using the asset is matched against the revenues earned from using the asset. The revenue is already computed. So if you don't charge depreciation, then the cost of using that asset to earn the revenue is never matched against the revenue, so your profits are overstated. Not charging depreciation means you are over-reporting your profits. That's the reason why we started.
Professor, let's say that at the end of the 4 years, you're able to obtain, let's say, $300 for materials or something like that, for recyclable materials. So you will put 300 where the zero is? Or?
No. If you actually get $300 by selling that equipment after 4 years, it just would all go in as profits on the sale at the end of 4 years. You can change the salvage value at the 4th year and do that. The salvage value is typically determined when the equipment is bought. It's not really determined, it is assumed. It's an assumption. Okay, so you make an assumption, a fair assumption based on what most companies use 0. Some companies use 5%. They'll just put 5% of 6,000 and that's your salvage value. So it's just different conventions in different
Okay,
places.
so if you sell it, then it will be an asset.
It'll be a gain. It'll be an actual gain in that year. Okay. All right. So now what we do is we can prepare a simple depreciation schedule where we say for each year how much depreciation you're charging that year, and therefore what your accumulated depreciation is. And this is important. The term book value. Book value, if you look at the balance sheet, and the balance sheet shows, let's say the balance sheet shows property, plant, and equipment at cost. Let's say $2 million. And let us say less accumulated depreciation, not the annual, but the accumulated depreciation. Let's say the accumulated depreciation was $800,000. This difference between the cost value of the asset and the accumulated depreciation, $1,200,000. This is called the book value. The balance sheet may not really call it the book value, but the balance sheet will report. So basically, the asset asset amount is really 1,200,000. We call this 1.2 million as the book value of the asset, meaning the original cost minus all the depreciation that you have charged on it till today. The total depreciation that has been charged on these assets till today would be the accumulated depreciation, and the difference between the two numbers is your book value.
That's
So
what
this is what we call as book value.
So book value is equal to.
Cost minus accumulated depreciation.
Basically, the amount of money left to depreciate.
Yes. Still to depreciate. Perfect. Very good. Very good. Yes.
Good job, Bob. Cost minus salvage value divided by estimated value. That's depreciation.
That is depreciation expense. That is annual. Every year, how much you depreciate. Correct. Okay. All right. So now what we have is that every year for the year 2003, your depreciation expense is $1,500, and your accumulated depreciation is also $1,500 because it's the first year. And so your book value is 6,000 minus the 1,500, which is 45,000. So the cost minus the accumulated depreciation is the book value. Now, second year you will charge a further depreciation of 1,500. In 2004, you will charge a further depreciation of 1,500, making the accumulated depreciation go from 1,500 to 3,000. Right? Because already 1,500, an additional 1,500. So now this becomes 3,000. So therefore your book value now becomes, you'll see the formula right here, so you will know how I got that. So the book value now becomes 6,000, the original cost, minus the accumulated depreciation of 3,000 or 3,000. See how the book value keeps going down? As the accumulated depreciation increases for the same level of cost, the book value keeps going down. So now therefore, at the end of 2006, the book value will be 0 because the equipment is fully depreciated. The point is that even after the equipment is fully depreciated, obviously that doesn't mean you cannot use it. If it is usable, you will continue to use it. But what will happen is that the depreciation will stop. You will use it without charging any more depreciation because it's fully depreciated. The cost is already allocated. So you don't have to worry about it. So while it is true, for those years, how about the matching of revenues and expenses? You're right. That is, it will be faulty. But at least you have made sure that the entire cost of the equipment has been matched against the revenues, over a reasonably assumed useful life.
Yes, the purpose of depreciating a PPE is to so you can have more expenses.
No, it is to match expenses to revenues.
Oh,
So if you think about it, let us say, take a case, let's say you're a consulting firm. Okay, so let's leave the cost of goods sold out. Let's say you're a consulting firm. The only fixed asset that you have is your building, where you have your offices, correct?
okay.
So now, so forget about depreciation. Suppose you don't depreciate. What your revenues are known, right? So all the money that you charge on your clients and all the billings that you have done, that's your revenue. What will be your expenses?
The utilities that you have to pay.
Utilities, the salaries that you pay your
Exactly.
staff, right?
Rent.
And the rent, or no, not the rent. You own the
You
building.
own the building.
So for example, it will be property taxes,
Taxes, yeah.
and things like that, everything, right?
Correct.
What about the use of that building? You have an office going on there. You are using that building to earn your revenue. That's an expense. So it is not to inflate expenses. It is to make sure that all expenses are considered in matching against revenues to compute your profit. So if you say that your profits are so much and that does not include depreciation, then your profits are overstated because here is an asset sitting there which you have paid for, you are using it, you are earning money out of using the asset, but the cost of using it is not matched. So your profits are overstated.
I see.
So it is the whole depreciation principle from an accounting perspective has to do with matching of revenues and expenses. If the depreciation is not charged, then the matching principle is violated. So that's it.
You can only depreciate for like 4 years.
Yeah, that will be, the life usually will come from the IRS system. Typically, the Internal Revenue Service has given a range companies will pull a number from that.
Okay, so let's, for the example that you gave about the building, let's say we give a life of 10 years.
Right.
So then you're counting, depreciation for 10 years, so you're matching.
Yeah.
After the 10 years, the building is still usable and you're still using it to collect rent money. You still have your expenses of property taxes and stuff. So then you're not matching anymore.
That, I already said that, but
Yeah.
you're repeating it, that's okay. I said, yes, you're violating that.
Oh, okay.
Beyond the 10 years, you are violating the matching principle. That's what I said first.
Oh, okay. Maybe I didn't understand.
Okay, But you got it now. Now that's very good. Yes, sir.
But how do you determine how many years you have to do?
That's what I said about the
The
IRS.
IRS.
The IRS has got ranges. So
Okay.
typically companies will pick a number within that range, so that way, you don't have to, but again, there's no way to know.
So they have like a specific item, this is this,
No, they will say buildings and they'll give a range. Say, for example, buildings, they'll give a range of 15 to 45 years. I'm just pulling a number.
Okay.
So therefore, depending on where the building is located, you may go closer to 15 or 45. So for example, if your building is located right on the beach or something, you may want to go a little lower in terms of age. But if it is located in a very interior area, good weather and everything, not prone to cyclones or earthquakes or anything like that, then yeah, you may want to go for a higher life. You may go at the other end.
But the IRS is gonna give a range.
Yeah.
So how do you as a business, you determine what's basically?
Most of the time you will know. I mean, if you ask your accountant, they'll tell you because they're doing the same type of work for other companies.
Right.
They'll tell you if you go by this, you should be okay.
So they go by what other business are doing?
Yeah, mostly bigger or other buildings located in that area, what they typically do. So that itself will not be an issue. Okay, it will not be an issue. But if you say for example, let's say you have a building and you pick a useful life for 1 year. Now that's going to raise a flag. Why would you build a building and say that it has a life of only 1 year or 2 years? Those are going to raise flags. So as long as you are picking a reasonable number in the range, you're going to be okay. Okay, so that's the book value. Now this is the method that most companies use. Now the related question is, since we are doing by method, I'm going to answer 2 and 3 both as it applies to each method. So that way we can understand both the disposal as well as the use. Now it is possible that you start using the machine, you start to depreciate it, and at some point in time you replace it, or you get out of that business altogether. That machine is used for a product line, and you're out of the product line, so you don't need that machine anymore. So you sell it. It's possible. You thought it will last you 4 years. Let us say, after 2 years of use, either you are withdrawing from the product line, or you simply don't want that machine anymore. New technology has come, so you're buying a new machine, and you're disposing of this old machine. Somebody else is willing to buy it. So how do you account for a sale of a long-term asset like this? Remember, that's not your business. Your business is something else. You're doing something else. Let's say X-ray. Your business is to get X-ray films done and charge your clients for making the films. Your business is not buying and selling X-ray machines. The X-ray machine for you is an equipment that is used to earn a business. But it is possible that even though you may think that an X-ray machine has a life of 30 years or 10, I don't know what they have. Let's say, whatever time it is. And let's say in the middle of the life, you decide to go to a higher, say a better machine, so you dispose of the old one. Now, when you dispose of a machine like this, then you are going to have to deal with the gain or loss on the sale of an asset. This is not revenues and cost of goods sold. This is straight out gain or loss. So how do you compute the gain or loss? The gain or loss on sale at disposal. So you're going to have a gain or loss. And the gain or loss is very simply computed as follows. It is cash on disposal. That is whatever you sell it for minus the book value. Remember, you keep coming up with a book value number. At any point when you sell the asset, update the book value up to that point, and you have a gain or loss. So the cash on disposal minus the book value, that becomes your gain or loss. Okay? So in this case, so let's look at this example. So let's look at this example. So initially, if the equipment is sold on 7105 for $1,000, what is the gain or loss on sale? Right? So now we have to make sure that the book value is obtained on the date of the sale, which is 7105. But our method here says we know the book value as of 12/31/04. Okay, as of 12/31/04, the book value is 3,000. And as of 12/31/05, it is 1,500. But we are selling it in the middle of that year. So what you have to do is to make sure that depreciation is charged up to the point of sale, a new accumulated depreciation is computed, and a new book value is computed. So what we will do is we will go here and we will say, okay, accumulated depreciation on 7105 is how much? Well, it is basically whatever it was at the end of the previous year, 3,000, plus half of the 2005 depreciation. Why? Because it was there for only 6 months. So as of July 1st, only 6 months have expired. So January through June. So for 6 months, it is half the year. So take one half of the 1,500, which is $750, and add it to your accumulated depreciation. So therefore, what you will have is that you will have $3,750 in accumulated depreciation. Once you know accumulated depreciation, you know what the book value is. 6,000 minus the 3,750. So the book value is therefore 6,000 minus 3,750 or 2,250. And you got $1,000 for sale for selling it. So 1,000 minus 2,250 is that now you have a loss of 1,250. Okay. Yes.
Yes. So now let's say instead of 6 months, it was 8 months. So you would take 8 divided by 12.
Times the 1,500.
Okay.
Correct.
Why is it a loss? You
Because you got less than book value. On the books, you are saying this asset is worth 2,250, but you got only $1,000 for selling it,
okay.
so you got to book a loss.
Okay.
You sold it for $1.
I understand, but my one confusion is the book value starts off at a larger amount when it depreciates down to 0.
Yeah.
However, the accumulated depreciation at 7105 is 2004 plus half of 2005.
So pretty much the book value is like,
Oh yeah, I understand.
like a car, when you sell a car, like the blue, whatever.
Yeah, the blue-
Cali Blue Book.
The blue book. So you go based on that.
But the blue book value typically will take into account market value.
Yeah.
Here, the book values simply take into account all the depreciation you have charged for. If you had charged very little depreciation, you are going to see high book value. If you charge a lot of depreciation already, then you're going to have a very low book value.
So what if you have an equipment and the equipment breaks down and you can't sell it?
Well, then
How would you
if you
account?
cannot sell, that's like disposal. So you're going to throw it away for junk. So the entire thing is a loss. The whole book value is a loss. Because think about it. You just say, whatever. Remember, what is the rule here? The rule says gain or loss is cash on disposal minus book value. So here you have some book value, but the cash on disposal is 0.
Okay.
So the entire book value becomes a loss.
Yeah, I just wanted a number, right?
When you don't, most of the time, when you don't know the number, you put a 0. No, I'm just kidding. Don't do it. The zero is actually one of the most beautiful numbers you ever have. It can, it can turn everything into nuts. I mean, 1 million times 0 is 0. That's where 0 is a great number. Yeah.
I'm sorry, I'm a little bit confused. So if the equipment is sold on July 1st of 2005, why aren't we using the book value, the $1,500 book value for July 2005, or are we using 2004?
Because the 1,500 book value for July 2005 is not July 2005. It is December 2005,
Or is it end of the year?
end of the year. That's why it is 1,500,
So why is it by 6 and not 7?
because it's the 1st of July. So July has not expired. Only June has expired. Only
Yeah,
6.
but
On the
I
1st of July, how many months have
That's
expired?
7 months.
No, on the 1st of July, how many months have
Oh,
expired?
6. Ah, I see.
No, what if it was 9 months?
No,
Then it will be 9/12 as he asked.
Okay.
If it was 9 months, so let's
9
say on
divided by
1st of
12,
October,
gotcha.
if it was 1st of October, then that would be 9/12 of the 1,500. Yeah.
Correct. I got you now.
Eso.
They're little things that, they could mess you up.
Yeah, they do.
All the
Yeah,
time.
they do. Okay. Is that okay? Now
Yes,
let's
sir.
go to the next depreciation measure.
Yeah.